So welcome back to my channel, and in this video we're going to talk about the 4% rule and how you can use the 4% rule for retirement. Now you might have heard of the 4% rule doesn't work anymore, the 4% rule doesn't apply in 2021, or the 4% rule is outdated and the founder who made the 4% rule has changed the rule. But nevertheless, if you want to understand how to use the 4% rule to retire faster for your future retirement, and what does it mean when you are thinking about safe withdrawal, then this video is made for you. Now, I have no idea how long this video is going to be, because when I'm looking at the agenda today, we have a lot of topics to go through. So if you're looking at the agenda right now, then you can see that the main topic and the goal is really how you can use the 4% rule for a faster retirement. What is it? What is the ideal time to take out money from your portfolio? What is the origin of the rule? And does the 4% rule work most of the time? When does it not work? And we will look at the last 10 years of S&P 500 data. And how does that compare with my portfolio? And what you should do when the 4% rule fails. And what is the number one misconception when it comes to the 4% rule? And we're going to dive into specific age ranges, which is between 20 to 60 years old, what you should do with the 4% rule, and what if you're over 60 years old? I'll also cover that scenario as well. And then afterwards, we're going to talk about the annual retirement expense by state, which is very helpful if you're living in US. If you're living in Canada, then it should be around the same because we'll arrive at a conclusion. And then afterwards, I'll also talk about how I withdraw money from the portfolio for expenses, and how to deal with stuff like leasing a car, which is a bigger expense, and its interest expense as well. And finally, I'm going to cover the critical elements to a successful retirement to basically help you think through this process. So by the end of this video series, you should have a good understanding of the 4% rule, how you can use it in an actual environment like your own situation, and we'll go from there. Now, before I start recording this video, I think I'm planning for around 2 videos if it is too long, but I'll try to cram everything within one video. If you think this video is too long, then click subscribe and like, and then when the second video comes out, you can watch it as well. But let's see if we can do it all in one go. So for those of you who are just discovering my channel, my name is Seto. I'm a CPA. I'm based in Vancouver and Hong Kong. And as of the time I'm recording this video for you, I'm actually in Vancouver at the moment, so you can see my mint house background. So I started investing when I was 18, and I tested well over 300 strategies for the last 8 years. And then I started growing my portfolio using a very specific strategy for the last 5 years. From 2016 to 2020, my return in total is 783%. And that is an annualized return of approximately 54% per year. Now, it's important to note that my target per year is only around 30% a year. So right now, I'm a little bit overachieving in terms of my annual return. And this is my YouTube channel where I share a lot of financial decisions, thinking process based on facts. So we're a very data-driven group here. We always look at the facts. We're not necessarily relying on other people's opinion. And basically, the goal of this channel is really to make finances simple and easy to understand for you. So with that being said, let's get started. Who is this video for? Basically, this video is for people who want to retire faster. And you have heard of the 4% rule, but you're not sure what it is, and you're not sure whether it is still applicable in today's market. And if you are interested in implementing the 4% rule for yourself, invest in the market, and basically have more control over your own retirement, then this video is for you. So let's dive into the first piece of data. Now, the 4% rule is the safe withdrawal percentage from your portfolio on an annual basis. So the 4% rule really revolves around taking money out of the portfolio. It's not necessarily an investing strategy, but it represents how much money you can take out of the portfolio and you can still retire for many, many years to come. Now, depending on what kind of situation you're looking at, whether you're looking for an early retirement before 40 years old versus you're at 65 and you're looking to retire for the next 20, 30 years, that assumption is going to change the situation slightly. But if you are able to follow the 4% rule, then you should be able to take out a fixed amount of money over a long period of time, whether that is 30, 50, 60 years to come. On the right-hand side, I'm going to calculate what is the withdrawal on an annual basis based on your portfolio size. Now, the first row you see is really $10,000, which means you can withdraw $400 on an annual basis. And the next row is $50,000, which you can withdraw $2,000 on an annual basis, so on and so forth. And initially, when you look at the first couple of rows, you'll see that, hey, Eric, it's not that significant. And that's exactly the point. And once you reach around $500,000 to $1 million, then you can start taking out a more meaningful amount on an annual basis. So for example, if you're looking at $500,000, which is $20,000, then that's approximately $2,000 a month, which can be quite a sizable amount. And if you're retired and you have a lower amount of expense, then hey, perhaps that's enough of living expenses for you. Now, if you're looking at the $2 million mark, then you will be taking out around $80,000 per year. So this is a little bit more reasonable. You can see that is probably covering 2 people's worth of expenses. If you're retired, for example, if you and your spouse are spending $80,000 per year in terms of expenses, then you need a $2 million portfolio. So you can actually pause this video and you can take a look at where you're at, and more importantly, where you want to be. And I think you're going to quickly come to the realization that, hey, most of us wants to be somewhere between the $1 million to $2 million range. And that's why when you're looking at North America, there's a very strong focus of becoming a millionaire, because once you reach that millionaire status, then suddenly you're able to produce enough return from your portfolio to replace your income. So that's really what you're looking at when people are talking about they want to be a millionaire, when they talk about the 4% rule and retirement. I also included 2 additional rows here where I included $5 million and $10 million. And these are really for our more overachieving friends on this channel. And you can take a look at how much money you will be able to withdraw if you're taking 4% out. Now, let me cover the first common mistake that most people make: taking money out of your portfolio too early. If you look at the portfolio on the right-hand side, you'll realize that it is not really meaningful to take money out until you hit $500,000 using the 4% rule. Now, most of the retirees I talk to need around $30,000 to $40,000 worth of expenses. So you're really looking at the upper range, closer to $1 million. So I would say your target portfolio size is somewhere between $500,000 to $1 million, which I think is pretty standard when people are doing retirement planning. Now, before you reach your desired portfolio size, you will want to let your money compound for you for as many years as possible. Now, if you are watching this video early and you're young, whether you're 30s or 40s or even 20s, then that is great because you have a lot of time to let compound interest work for you. If you start taking money out of your portfolio too early, then that'll actually slow down your growth, which will require you to work harder and longer and save more money in the future. So that's why investing is such a long-term endeavor, because you need compound interest to work for you to get to that $500,000 to $1 million mark. So this is really where most people realize that they need to become a millionaire in order to retire. And that's why in North America, they glorify and place a lot of emphasis on becoming a millionaire. Basically, when you are becoming a millionaire, you have made it. And based on this calculation, you'll realize that, hey, being a millionaire and following the 4% rule only generates around $40K in terms of income per year. And when you think about it, it's actually not that much in the grand scheme of things. So maybe it's due to inflation, maybe that dogma or concepts is kind of outdated now, but being a millionaire in North America actually don't mean that much in terms of the 4% withdrawal rule, because you're only making $40K a year. Now, of course, if you pay very, very cheap rent and you don't need to work a job, then you can possibly travel, and you have a budget of $40,000, which is not bad. But when you think about it in terms of the absolute sense, $40,000 a year is not exactly fantastic if you are an engineer and you're making 60 to 80K or even 100K, or you're a doctor that's making well over 100K. So depending on your lifestyle, you really need to think about what is the amount of money you need in order to retire following this 4% rule. In the next slide, let's talk about how reasonable it is to take out 4% of your portfolio per year. And we'll also be stepping into the origin of the 4% rule and how the math works and so on. So right now on this slide, you will see the S&P 500 return for the last 10 years. Now I could have done this analysis over 30 years, but for simplicity, let's look at the last 10 years. And I also went ahead and pulled out the inflation number on an annual basis. And you'll see that there is the inflation number from 2010 all the way to 2020. We don't have the inflation number for 2021 yet. Basically, what this table is trying to achieve is to help you understand what is the residual return you're getting from S&P 500 after inflation. Now, why is this the first example? And this is because when you're looking at the average investor's portfolio, if you are fully diversified, you should be pretty close to S&P 500. Now, you might be paying 1% in management fee, or you might be paying 2% in management fee, which I would consider it to be very high. You can still get a return that is very close to S&P 500. So in this case, here you will see S&P 500 in the first column. For example, in 2020, it was 18.4%, which is phenomenal. The average return for S&P 500 is around 8% to 10%. So you can see in 19 and 20, S&P has been performing a lot better. So if you take that and minus the inflation amount, then you'll get the third column, which is the residual by year. Now in 2020, it is 17%. That is the residual net of inflation. And in 2019, it's 29%. So here you can see that in both years, if you just take out 4% of your portfolio, then you'll still be doing fine. You have more than enough left over for your portfolio to maintain its balance and continue to grow going forward. So that is great. But what if you look at 2018? Then that's when the 4% rule is not enough. In 2018, the inflation is 2.44%, and you can see the S&P 500 return is negative 4.38%. So that means the residual is negative 6.82%, which means after inflation, your portfolio actually shrunk by 6.82%. So if you want to take out another 4% in 2018, then that will really hurt your portfolio in terms of its balance. And basically for that year, your portfolio is not growing. And if you needed the money, then your portfolio will decline even more. Now, if you look at the 2017 and 16 figures, then again, it is okay again. Then if you look at 2015, that year, S&P 500 only netted a 1.38% return, and inflation was 0.12%. So the net residual return there is 1.26, and that is actually not enough to take out 4% without decreasing the balance. So in 2015, it's also a year where the 4% rule didn't necessarily work. So if you look at the last 10 years of data, then you'll come to the conclusion that out of 11 years that we got here, 3 years actually didn't work. But most of the time, the 4% rule works, and there's usually enough residual value for you to take that money out. Now, when you're looking at this chart, you need to keep in mind that the S&P 500 is 100% stocks. And as you get older, your financial advisor will probably tell you that, hey, investing in all stocks is risky, so you should probably add some real estate investment trusts or add some bonds into it, which will lower your return because usually stocks will offer you the highest return, and then it's REITs, and then it's bonds. So bonds offer you the lowest return, but it also gives you the guarantee that you're getting a certain amount of return for sure. So when you think about it, okay, even if you invest 100% in stocks, your residual 3 out of 11 years didn't work. So this is a problem that we'll have to solve later in the video, so make sure you stick around. Now, at this point, I also like to evaluate my own portfolio against this 4% rule to see if there is a situation where it doesn't work and what to do about it. Now, in this case, I'm going to make it simpler because I only have been using the same strategy since 2016. So we're going to look at the last 5 years of data. So in 2016, my return was around 78% using my strategy. 17 is 40%. And in 2018 was only 3.58%. So this is actually a number I pulled directly from my broker, which is TD Canada. And in this case, you can see that year, S&P 500 was actually negative 4.38%. And even though I kind of did a relatively good job beating the market and getting a positive return, which is 3.58, I still didn't meet the requirement to make 4%. And if I remember correctly, let me just go back one slide. The 2018 inflation was 2.44%. So that means I actually didn't meet the 4% rule. So even if you get a strategy that is performing better than the market, it doesn't necessarily mean all the years you'll be able to satisfy the 4% rule. So how should you prepare for that kind of situation? And that's exactly what we're going to be addressing in a bit. So when you're looking at my annual average return, it's approximately 40% to 50% per year. So once you annualize it, that's what it would be. Out of the last 10 years, S&P 500 return fails in 2011, 15, and 18. So 3 out of 11 years, it has failed. Now, to solve this problem, we actually need a buffer for the volatility within the market, because obviously the market doesn't go up in a straight line. So you need some sort of buffer. So that means during the bad years, you want to have some cash on hand before the bad years happen. So for example, in 2020, 2019, you probably want some additional cash on hand that allows you to weather through 1 to 2 years of bad market. Now, when we're looking at the last 11 years, the bad years are only individually happening, so they're not consecutive bad years, but we can't remove the possibility that there can be 2 consecutively bad years. And because of that, we should prepare for around 1 to 2 years worth of cash to be invested in something like money markets or bonds, basically to provide you with some sort of buffer when you're taking money out. You don't need to take out money immediately. Now, if you have a more capital gain focused portfolio like myself versus a more dividend focused portfolio, which is not something I focus on, then I'll also talk about how to take out money during that time, because for capital gains focused portfolio, you need a little bit more timing versus a dividend-driven portfolio where you get paid on a quarterly basis or a monthly basis on an annual basis. Okay, so basically the solution to that is to create a buffer. And in my opinion, I think if you have a buffer of 40K to 80K, which is 1 to 2 years of additional capital that is not invested in stocks or whatnot, then I think you will be able to do fine. And this can only be done during a good year. For example, in 2019, where the S&P 500 return is 31%, you can take a little bit more than 4% to weather through that storm. Okay, so by now you probably understand that the 4% rule is really a strategy for the end game. You're trying to take money out when you're retired. You're trying to take money out when you don't have as much income. But what if you are working? Because most people that are watching this channel, you're going to be working between 20 to 60 years old, maybe up to 65 years old. And your goal is really to reach that desired level of wealth as soon as possible. Now, in this case, we'll just use a round number, which is $1 million. And basically, you're trying to get there using the money you have in your portfolio, and you want to leave it alone. And at this point, you want to be utilizing all of the tax advantageous accounts, such as 401k, Roth IRA in US or IRA, and in Canada is TFSA and RRSP. And I did a whole tax series on my channel on how to use TFSA, RRSP, how to pay as little capital gain as possible, so you can watch those videos as well. And basically what you're trying to achieve here is to make sure that most of your 100K is compounding tax-free. Because the last thing you want is to pay a lot of taxes along the way, because that would actually slow down your growth and make you take a lot more time to compound and reach that retirement goal. And I actually did another video on that as well, and basically explaining the tax impact if you are taking a profit every single year. Now on the right hand side, you will see the table I've created for you. Now the first column you see is that if you have $100,000 and you fully compound it without taking any money out or putting any money in, and you make 10% per year for the next 15 years. Now this is actually quite interesting because you can see that if you are starting to plan for retirement when you're 50 years old, you start with 100,000, of course you will save more money, but then if you keep compounding without taking money out, let's say in a 401k or a Roth or TFSA or RSP, at the end of 15 years, you'll be at $379,000 and $750. Okay? Now, what if you make 10%, but you want to take 4% out? You're following the 4% withdrawal rule. Now, if you do that, then what you'll end up getting is starting 100,000 and it will only grow to 226,000. So you can see that the growth there actually slowed down significantly. Is the difference between $150,000. So that's actually quite significant when you think about it. And if you're looking to achieve that 1 million mark ASAP, then you need to have that discipline to not take money out. Keep letting it invest and work for you, because initially it is going to be slow. And if you take money out, then it's going to be even slower. And it might be so slow that you might not get to 1 million even after 15, 20 years. And you can see the math here. If the market is not that surprising, then it should follow this projection. Now in the third column, I also added fully compounded 30% return. And this is really for my own amusement because my target is to make 30% return a year, and also for some of the students in Investing Accelerator because their target is also making 30%. So here you can see that it started with $100,000, no capital injection or withdrawal, and it will keep compounding. And by the end of 10 years, you will see that the capital has basically 10x. And this will allow me to reach $1 million in year 10, and then afterwards to continue and grow after that. So in this case, you can actually see someone investing $100,000 and achieve financial freedom in a relatively short amount of time, which is 10 years. And you can imagine if for some odd reason you're 20 years old, you have $100,000 and you reach $1 million by 30, then bam, you're retired. And whether that you're 40 years old and you have 100,000, invest, compound 10 years, and bam, you're retired. Now, at this point, for those of you who don't know me, then you'll probably think that, oh, hey, I have never heard of people making 30% before. It sounds ridiculous. How come I go to the bank and nobody tells me that I can make 30%? And the answer is because most of the strategies that allow you to make 30% are not available in the bank. So for example, private equity funds, investing in startups, investing in hedge funds, they can aim for 30%, sometimes even more, but those strategies are not in the bank. So if you go to the bank and ask the teller or the financial advisor, they're not going to give you a fund or a mutual fund that is an index that can get 30% return per year. Now I want to cover the next slide, which is what to do if you are 60 plus years old. And if you have reached your desired portfolio, then that's great. You can start taking money out. And should you take it all in the beginning of the year? Should you focus more on dividend stock? How should you structure your portfolio? For a capital gain driven portfolio like myself, I like to take money out of the portfolio when I take profit. And this is important because I try to time the market in a way where I'm maximizing the profit taking. So I don't take money out because I need the money. I take money out because it is at maximum profit. So that's kind of what's important. And this ensures that my money is only taken out when out of the market when I need it, and I try to exit at a high price as much as possible. I'm probably going to get attacked for saying that I time the market, because I do, and I try my best to time it. It's not perfect, but if you are able to time the market and get that extra 5%, 10% out of the market, then hey, why not? Now, if you are 60 plus years old and you're a little bit more conservative, you don't like having your entire portfolio focuses on capital gain instead of dividends, then you can choose a more income-driven approach for your portfolio. Now, your taxes might be higher because obviously dividend and capital gains have very different tax rates, which I covered in another video in my tax series. But if you don't think you will be able to time the market and you want some sort of certainty, whether that is a monthly dividend, a monthly interest distribution, or a quarterly dividend or whatnot, then you can structure a part of your portfolio to be that way. But you need to keep in mind that, let's say you structured a $30,000 dividend per year portfolio, and you don't need $30,000 that year, then suddenly you're getting taxed on that dividend, and you need to reinvest that dividend back into the stock market, which can be quite troublesome. So in a sense, what you're doing to yourself is that I'm investing in a stock, I'm getting dividend, which is money that I don't need or I don't need right now, and I reinvest it because I don't need right now, but then I still get taxed on it because I got paid a dividend. So when you think about it, that's why I'm a strong advocate of capital gain, but that's also because I'm younger and I don't feel like I need any dividends at all. So I think this is a matter of preference and skill, because when you're 60 years old and you want some dividend, you want some guaranteed income, then I think fine. But when you're looking at guaranteed or dividend income that is very predictable, then the return will also be lower. So when you are looking at a high dividend stock, for example, like 8%, 9%, 10%, then usually you have almost no capital gain and the stock price will also go down. So you got to keep that in mind, because if you invest in the stock that is going down, then over time, your stock value is worth less and less and less. And in the end, you don't get back the stock value. And basically, the stock itself has gone down so much that your capital is gone and is paid out through dividend. Now, the next thing I did for you is really to calculate the annual expenses by state. And this is actually an article I found on Yahoo Finance. And then I kind of grabbed the data, I cleaned the data, and then afterwards I took that number, divided by 4%, which is the withdrawal rule that we're talking about here, to calculate what is the portfolio balance you need by state to retire. If you are looking at this chart, you can actually pause this video, change it to high definition, and look at your own states. I'm just going to highlight a couple of states here, but basically I think you can look at what is the portfolio balance you need. It is sorted. So the lowest annual expenditure to retire is Mississippi. So congratulations, my subscribers who are living in Mississippi, Kansas, Oklahoma, New Mexico. So these are the states that have the lowest annual expenditure. And your portfolio balance just needs to be around 1 million to 1.1 million in order for you to retire. So when you think about the next 10, 20, 30 years, you just need to figure out a way to get to that balance. Now, of course, if you tell me, hey, Eric, I'm actually a more frugal person. I don't spend that much money. I don't have much hobbies. I don't like to travel. I just kind of take care of my garden and retire. And I just need 20,000 to retire per year. Then, yeah, you can just follow the formula. Take that 20,000 divided by 4%, then you'll get to the portfolio balance you need anyways. Now, some of the more expensive states, which are also some of the locations I want to retire in, would be California, New York, not really, District of Columbia, and Hawaii, which is one of my favorite states in the United States. And here you can see the annual expenditure is $100,207. So this means you will need a portfolio of 2.5 million, which is the highest across all the states. So you can see that is actually pretty intense, because what is the possibility that someone can make $2.5 million to retire by 65? Now, depending on your income and your occupation, this might seem like an achievable goal, but I know a lot of people that it will be quite a bit of effort in terms of savings to get to this 2.5 million mark. So when you think about it, there's got to be a better way to retire faster. And when you're looking at the financial independence and retire early community, you'll find that they always talk about moving from a high cost of living location to a low cost of living location. And looking at this slide, you will be able to clearly see why that is so important. Because if you're living in Hawaii, you need to save 2.5 million. If you're living in Mississippi, then hey, you just need to save 1 million. So it's a lot easier to retire in certain states compared to the other ones. Now, I'm going to move on and talk about how I withdraw money from my portfolio when there is a large expense. And I actually created a YouTube series about this earlier called Wall Street Buys Me a Tesla. And basically, I'm trying to buy a Tesla that is around $75,000, $78,000 using capital of $75,000. So basically, the premise of that video series is that I could have bought that Tesla today, but instead I decide to invest it first, wait 3 to 5 years, and then buy the Tesla I want. So this is really a great example of delayed gratification. And I basically use $75,000 to make $78,000, which is approximately 30% per year, which is you double in 3 years. And this is really achieved through multiple investments. It's a 3-4 video series where I invested in American Express, Kirkland, Pfizer, which is the vaccine stocks, and also Altrix as well, to achieve that $78,000 in the span of 1 to 3 years. And surprisingly, I actually achieved that in 1 year. I guess the market was doing a little bit better than I expected, but my original plan is to achieve that in 3 years. So far, my latest and last investment was Pfizer, where I put in $100,000 and I made 30% after 1 to 2 months, because obviously Pfizer vaccine is really popular right now and the stock also went up. So how does that apply to withdrawing money from the portfolio? So when you're withdrawing money from the portfolio, I'll try to time it around the exits. So when I invest in Pfizer, my plan was to hold it for a year. Now, of course, the stock went up faster than I expected, so on and so forth, and I exited after 2 months approximately. So at that point, when I take profit from Pfizer, then I will take out the money I need to buy Tesla. Now, of course, did I do that? The answer is no, I didn't, because I realized I kind of made too much money too quickly. So then I need to reinvest that capital until I'm ready to buy a Tesla. Now, there's one more consideration. When it comes to buying a large purchase like a car, my goal is really to make that monthly payment. So I want to invest my capital and take on a lease from Tesla, so then I pay a monthly payment instead of a lump sum. Now, you might be wondering, hey, Eric, that means you're paying interest on the lease. And the answer is yes. And I'll talk about that in a bit. But basically, I'll reinvest all of my capital and only withdraw the amount needed for the lease. So for example, let's say I take on the lease and the lease payment is approximately $700 a month for Tesla. And what I would do is, when I exit Pfizer, I would actually take out a year's worth of lease payment, meaning that I would take 700 times 12, which is approximately $8,000, and I would use that and put that money aside in a cash account. I'm not going to invest that money when I exit Pfizer, and for the remaining $122,000 that I took profits after investing in Pfizer, I would use that to invest in something else, and I don't need to take money until my next stock position becomes profitable and I take money from that. So that's actually how I would do it on a very mechanical basis. And this allows me to have that buffer, minimize the amounts of capital that I'm not investing in, and reinvest as much as possible because I don't need most of the money today. And that is really how I maximize reinvestments of my capital. So when you look at the portfolio cycle, I would only have $8,000 that is idle in terms of cash, whereas all my money is fully invested in the market and working for me. So, okay, when you're looking to lease an asset, you need to make sure that the money you use to lease is for a good cause. You are using it to invest in good investments. You're not using it to spend on other consumable items that is not making you money. And what's important is that the return you're making needs to be higher than the lease interest rate. So that's what's important. Because typically, the lease interest rate I see is around 6% to 9%, depending on your credit score. Now, right now, the interest rate is very, very low, like 0 to 1% from the Bank of Canada or Feds. So you might be able to get a lower lease interest rate, which is 4% to 5% return. But I expect that in the next couple of years, the interest rate will be going up. So you need to be careful, because when you hit that 6% to 9% mark, then you'll realize that it is not very beneficial to lease a car, because it's the same return as you would get from S&P 500, which is 8, 9%, maybe sometimes 10%. So unless you have a strategy that allows you to get a significantly higher return, so for example, my strategy targets 30% return, then it might not be beneficial to lease a car. You might be better off if you just buy the car with full cash and then you depreciate it within your business and whatnot, then you can pull it off. But yeah, if you're not making a very high return, like 3, 4%, then you might be better off just paying off the lease, just buy the car with all cash and go from there. And some of the other options, of course, is to buy a used car. So this situation only applies if you're trying to buy a new car. There's also an additional situation, like what if you want to buy a car, you don't have enough capital, and you don't want to pay a higher lease interest rate? Can you use a line of credit to buy it? Now, first step to that is really you need to check your house to see if you have a line of credit that is having a very, very low interest rate. So I'm talking about 2%, 3%. Now you can try to take advantage between the line of credit interest rate, which is 2 to 3%, versus the lease interest rate, which is 5 to 9%. So what you're doing here is essentially you're taking the line of credit 2% to buy a car using all cash, versus getting a lease from the dealership, which is 5 to 9%. So using that, because there is security, so on and so forth, then you are basically having an arbitrage where you're making the difference of 4 or 5% between the lease and the line of credit. Now, in this case, you actually need to be careful, because interest rate is looking to increase in the future. So obviously, the lease interest rate will not increase if you enter into a lease for 5 years, but the line of credit interest rate might fluctuate based on the market. So if Feds tomorrow announce an increase in interest rate, then boom, your line of credit interest rate will be going up as well. Okay, of course, you want to use your line of credit to invest in the market. And you should only do this if you are absolutely sure that you'll make money and make a higher return than the line of credit return. So if your line of credit is 3%, then you need to be absolutely sure that A, you don't lose it because it's not your money, and B, you make more than 3% or whatever the interest rate is for your line of credit. And if your line of credit is more than 5%, then probably is not worth it to take that risk, because that rate is actually quite high, in my opinion. So you're probably better off sticking to stocks and not use any line of credit. Okay, so finally, we're going to cover the critical element to retirement. Here you will see there are basically 3 factors that you need to consider. So the first one is how much you save when you're working a full-time job. And this really depends on your lifestyle. If you are a frugal person, then that's great. You should be saving a lot more. But if you have family, you have 4 kids, you want to travel a little bit while you're still young, then you're saving less. So this is within your control, but it also depends on your lifestyle and what kind of standard of living do you want. Now, the second one is how long you can invest for. And the answer is, so it's 65 years minus your age. And you should be better now, because after watching this video, you should be very motivated to start investing today. Because when you look at the chart on the right, the earlier you start investing, the more you can compound. And when you think about investing in retirement, the most of the gains is not achieved in year 1 to year 2. Most of the gain is achieved in year 14 to year 15. So if you look at the difference from year 14 to year 15, it goes from $345,000 for the first column to $379,000. And that amount difference alone is like $35,000 or so, versus the first year where the difference is only $10K. When you invest late, you kind of put up that decision, you kind of delay it because you're indecisive. The cost of investing is not the first year. The cost of investing is the last year. So the earlier you start, the more you compound and the more money you make. near the end. And that is the tricky part about investing because it is based on time. And the only way you can speed it up is the third factor, which is how much return you make. And that depends on your investing strategy. So if you look at the table on the right again, then the first column is your typical S&P 500, 10% return. The third column is a more advanced strategy that requires more management, that requires more in-depth financial knowledge. And that is my target personally as well. So here you can see that in year 4, you can actually double your portfolio using a 30% return. So when I say year 4, it really means year 3 because in year 1, you're starting with 100,000. So it should actually be year 0. But just stick with me here. So if you are able to achieve 219,000 in year 4, that basically allows you to double. When you follow the normal 10% return, it would take you year 9 to get to the same amount. So essentially what you're doing is, if you can make 3 times the return, then you'll get there 3 times faster. It's kind of obvious, duh, Eric, we already know that, but I'm just pointing it out and giving you the math so you can see it clearly yourself. And that brings me to my investing strategy. So I just want to celebrate another couple of case studies within Investing Accelerator, where Flo made 41% from Bank of America in 5 months. That's fantastic. Flo is actually a lawyer in Australia. Serena made 18% from TD after 40 days, and that is fantastic. Serena is based in Canada, and she works in the IT field. And this time she used stocks, not options. And Venkatesh made 80% from Boeing in 2 months, and this time he actually used options. And this was actually made after COVID when Boeing was cheap. So if you're looking at this video now, you can still take a look at the charts and see how he made 80% using options. Now, Tony also made 104% from Boeing in 3 months. So obviously his holding period with Venkatesh is slightly different. And Eric, he's an engineer, he's retired, and he made 100% from Boeing in 1.5 months. And finally, Mike, a doctor in the United States, made 30% from RTX, which is actually a defense company, in 5 months. So these are all great case studies from Investing Accelerator, and congratulations to you all. Now, if you're interested in becoming part of Investing Accelerator or learning more about it, then there's actually a free case study in the description. It's actually just the first link, and if you click on that link and you watch the 4-hour webinar, it actually outlines how I invest, how I help people to achieve this kind of return. And after that, if you are interested in becoming part of Investing Accelerator, then yes, you can schedule a free chat with me. It's called a free strategy session to chat with me, and then I'll assess your situation and see if you are a good fit for the program. And if you are a good fit, then you'll be a part of Investing Accelerator. And on average, each month, I'm looking to help around 20 full-time professionals without a financial background to master investing. So the target is 30% return a year, and sometimes I can accommodate 30 people, but my target is really 20 a month. So that's my goal, and that's how many people I help on a monthly basis. So that is it for this video, and turns out I'm able to fit all that content within a single video, which I'm sure we are at like the 40-something minute mark now, so it's quite long. So let me know down below in the comment section to see if you like this kind of long video or if you prefer shorter ones where I only have 10 minutes or whatnot per video. So those are more concise, where this one is more an in-depth, a more complete guide to certain concepts in terms of finances. And in this case, it's the 4% rule. And if you have implemented the 4% rule successfully, let me know in the comments as well. I would be interested to know how is that going, what you do during the bad years. Is there a better strategy to weather through the bad times other than having a buffer of 1 to 2 years, which is my plan for now? And if you have any additional ideas, let me know in the comments section below. So I'm looking forward to chat with you. And previously, for one of my most popular videos, which is the capital gain tax, I do try to reply to all the comments. So if you leave a comment below, then I do read it and I'll like it for sure. So yeah, that's it for this video, and I'll see you in the next one.